Welcome. So, if you're a retail investor who's ever bought a call, sold a put, or maybe even just stared at a stock warrant wondering what it is, then you've come to the right place. Let's dive right into this super important and, let's be honest, kind of confusing world of taxes on options and warrants. So, let me just ask you, straight up, are you trading options? Or maybe you dabbled in them over the past year. If you're nodding your head yes, then there is something you absolutely, positively need to know. You heard that right. Every single time you close a position for a gain, exercise an option, or heck, even let one expire worthless, you're basically creating a paper trail. And you can bet the IRS is very interested in that trail. It's really not a matter of if you'll owe taxes, but how they're going to get calculated. And that brings us perfectly to our first section here, the inevitable tax bill. Think of this as the absolute ground rules. Trying to trade without knowing these is kind of like driving with a blindfold on. It's just not going to end well for you.
So get this, most of the time, when you make money on an options trade, it's going to be taxed as a short-term capital gain. That's the same rate as your regular income, which is not great. But it gets way more complicated from there. The math literally changes depending on your strategy. Buying calls is different from writing covered calls, which is different from exercising. Each one has its own special tax treatment. And yep, you guessed it, every single one of these moves has to be reported.
Okay, let's build on that. Section 2, calculating your core position. Before you can even begin to figure out what you made or lost, you have to know what your investment really cost you. We call this your cost basis, and believe me, it is the bedrock for every single tax calculation that follows. Let's walk through a super simple call option example to see how this works. Imagine you buy one call option for, say, company ABC, and you pay $100 for the premium. Sometime later, you decide to exercise it. You buy the 100 shares at the $20 strike price, which costs you $2,000. Now, here's the key part that a lot of people miss. To find your true cost, that initial $100 premium you paid gets added right into it. So, your total cost basis for those 100 shares isn't $2,000, it's $2,100. This is the number the IRS actually cares about. This is your starting line for figuring out any profit or loss down the road. So let's see this trade through to the end. The stock does great, it goes up to $28 a share, and you decide to sell. Ka-ching, your sale brings in $2,800. Now, to find your taxable gain, you just subtract that cost basis we just figured out, the $2,100 from what you sold it for. And there you have it, a $700 short-term capital gain that you've got to report. Simple as that. All right, now that we've got the basics down, let's dig into some common strategies. Things get a little more interesting here, but we're going to make it easy to follow by using an example with a trader we'll just call Taylor. Okay, a really popular strategy, especially for people who already own a stock, is the covered call. So Taylor owns 100 shares of Microsoft and decides to sell a call option against them to make a little extra income from the premium. Smart. But how that income gets taxed depends entirely on what happens next. As you can see, this one little decision can split into 3 totally different paths. If the option just expires worthless, cool. Taylor keeps the premium, and it's a short-term gain. Nice and easy. But if the option gets exercised, Taylor's shares are called away, and that premium gets added to the sale price when figuring out the total gain. And then there's the third path. If Taylor buys the call back to close the position early, that creates a whole separate gain or loss on its own. 3 different outcomes, 3 different tax events. Wild, right? Okay, let's wade into the deep end now. Navigating the special tax rules. This is the real fine print, and I'm telling you, understanding this stuff can save you from some seriously nasty tax surprises. Here's a rule that trips people up all the time: the difference between a qualified and an unqualified covered call. If you write a call that's deep in the money, the strike price is way below the current stock price, and it has less than 30 days to go, it can become unqualified. Now, why should you care? Because it freezes your stock's holding period. That means even if you've held your shares for over a year to get that sweet long-term tax rate, this one trade could force your profit to be taxed at the much higher short-term rate. It is a very easy and very, very costly mistake to make. And then there's the infamous wash sale rule. This one's a big deal. Basically, the IRS says you can't sell a stock at a loss to get a tax deduction and then immediately turn around and buy it, or something substantially identical, like a call option on it, right back within 30 days. If you do that, the loss is disallowed for now. Instead, it gets added to the cost basis of your new position, which just makes all your future tax math even more complicated. Okay, listen up, because this is a point that's so important it's worth repeating. When you sell an option to open a position, we're talking short calls or short puts. Any money you make or lose is always treated as short-term. I don't care if the option has 2 years until it expires. As far as the IRS is concerned, it is a short-term trade, period. All right, let's switch gears just a little bit. We're going to move from options to their close cousin, something you might have even seen pop up in your brokerage account, stock warrants. They look and feel a lot like call options, but trust me, there are some really important differences in how they actually work. So what in the world is a stock warrant? Well, unlike an option, which is just a contract between traders, a warrant is issued directly by the company itself. That's a huge difference, because when you exercise a warrant, the company actually issues brand new shares of stock. This is critical to know because it dilutes the value for everyone who already owns shares. Now, the logic for when to exercise a warrant is pretty simple. If the stock is trading for more than your warrant strike price, it's a good deal to exercise. You get to buy shares at a discount. But if the stock is below the strike, it makes 0 sense. Why would you? You could just buy the shares for cheaper on the open market. But remember, even a warrant that's out of the money might still have some time value left, which means you could potentially sell it to someone else. So how do you actually do it? It's probably a lot easier than you think. The simplest way is to just call your broker. You tell them which warrants you have and how many you want to exercise, and they do all the heavy lifting. They handle the communication with the company, and before you know it, the warrants will just vanish from your account, and the new shares will pop right in there. Here is a pro tip that could save you a massive headache. Unlike standard options, where one contract is for 100 shares, warrants don't always have a 1-to-1 ratio. Sometimes it takes 5 or 10 or even 20 warrants just to get the right to buy a single share of stock. So please, always check the specific terms so you know exactly what you're holding. All right, that brings us to our final section, the bottom line. We have covered a ton of ground here, from cost basis to covered calls, special tax rules, and warrants. So what is the single most important thing to take away from all this? It's this simple, direct quote from our source material: taxes on options are incredibly complex. Look, this isn't meant to scare you away. It's just to really hammer home how important it is to get this stuff right. These are not rules you can just kind of guess at and hope for the best. So what do you do now? Well, use this explainer as your jumping off point. Start digging deeper into the specific rules that apply to the strategies you actually use. And please remember that this is not official tax or investment advice. Honestly, the single best thing you can do is find a tax professional who gets active traders. They are worth their weight in gold, I promise you. And that leaves us with one last big question for you to think about. After everything we've gone over today, just take a second and ask yourself honestly, are you really prepared for your next tax season?